Outlook Therapeutics, ticker OTLK, missed consensus for Q3 2026. Adjusted EPS came in at a 9-cent loss, missing the 8-cent estimate by about 12.5%. And the top line was, well, a massive shock. Revenue printed at just $9,000.
Wait, 9,000? Like not 9 million.
$9,000 exactly. And that was against a $966,000 consensus. But, looking ahead, management guided for $50 to $75 million in net revenue during the first 12 months following their upcoming U.S. launch, targeting $500 million in peak annual sales by 2030. They also project SG&A expenses will double by the end of calendar 2026. Unsurprisingly, the market punished the miss. Shares dropped 5.5% in pre-market trading to 84 cents and eventually slid over 10% following the report.
Right, so now that we have those headline numbers out of the way, let's welcome you to your custom deep dive. Today, we're unpacking a stack of your earnings notes and analyst reports to figure out our mission. Basically, how does a company projecting $500 million in peak sales just print the equivalent of a used Honda Civic in quarterly revenue?
Okay, let's unpack this because, if a global company prints $9,000 in a quarter, that's not a rounding error. That's a stalled engine.
It absolutely is. When you look at your notes on their European segment, you'll see they had about $1.5 million in initial channel stocking a year ago. But you have to realize those commercial operations they've stalled almost completely.
Right, just completely flat.
Exactly. Management tried to highlight a 46% sequential unit increase in Europe on the earnings call. But when you're growing off a base that tiny, the absolute dollar value is still practically zero.
Yeah, percentages can definitely be deceiving there, so the revenue's evaporated. But wait, hold on. Shrinking their adjusted net loss to $10.9 million year over year sounds like good news on paper, right? But if they just slash R&D by 54% down to $3.3 million because their major clinical trials are over, that's not a real efficiency gain.
No, not at all.
That's just the calm before the storm. Once they pivot to actually selling this drug, won't those marketing and sales expenses just absolutely crater their balance sheet?
Spot on.
Yeah.
You're looking at a structural shift, not sudden operational efficiency. The cost savings are purely temporary. They are transitioning from this R&D holding pattern into aggressive commercialization.
Which gets expensive fast.
Incredibly expensive. That's exactly why management guided for their selling, general, and administrative expenses, the SG&A, to double. The cash burn rate is about to accelerate rapidly.
Here's where it gets really interesting. Management's entire focus right now is the late 2026 U.S. launch of their drug, LYTENAVA. For context, this is the first FDA-approved ophthalmic formulation of bevacizumab to treat wet AMD.
Which is a chronic eye disorder causing blurred vision or even blindness, just for those who might not know.
Exactly. And they are planning a wholesale acquisition cost, or WAC price, under $500 per vial. But the critical trigger for adoption is securing a permanent J-code by April 2027.
And for you listening, a J-code is essentially a permanent billing ID used by Medicare and commercial insurance. Without it, the reimbursement process is just incredibly manual and risky for doctors.
Yeah, nobody wants to deal with that paperwork.
Right. Clinics simply won't risk buying the drug in volume because they aren't guaranteed insurance will quickly pay them back. But what's fascinating here is how that launch plan collides with the balance sheet. They ended the quarter with a dangerously low $11.2 million in cash.
Wow, that is tight.
Very tight. To survive the massive upcoming cash burn you just mentioned, they executed a highly dilutive $51.1 million public offering at 99 cents per share, literally right after the quarter closed.
Brutal timing for the shareholders.
Yeah, they basically bought themselves the survival runway to reach that J-code, but at a massive dilution cost to existing investors.
And even with that new runway, they are launching into fierce headwinds. Think of the current standard of care like a generic store-brand medicine. Clinics currently use off-label compounded bevacizumab that costs patients just $10 to $15 out of pocket. OTLK is trying to sell them a premium FDA-approved version for $500.
Exactly. The FDA approval gives them a differentiated, heavily regulated product. But this operates in a physician-administered buy-and-bill market.
Meaning the clinics are the ones fronting the cash?
Correct. Clinics buy the drug up front, administer to the patient, and then bill insurance. Practice economics guide the decisions here. The profit margins on the $15 off-label version have kept the lights on in these clinics for years.
So it's a huge behavioral shift.
Generating that guided $50 to $75 million is going to require flawless execution to change deeply ingrained doctor behavior.
Which brings us to the ultimate question for you to mull over. Management's model heavily relies on a $300 million upside scenario where the FDA cracks down and disrupts those off-label compounding pharmacies due to infection risks.
Right, the regulatory hammer.
Exactly. But what if they don't? If those cheap $15 off-label options remain completely untouched by regulators, can a $500 vial ever convert enough of the market to jumpstart the stalled engine and justify the massive upcoming cash burn?
It truly is the multi-million-dollar question.
Make sure you follow the show for your daily earnings deep dive coverage so you never miss the numbers that matter.